There is a good news for foreign investors. The so-called revenge tax under Section 899 of the Big Beautiful Bill is being removed. And this provision had raised a concern among the international investors, as its inclusion would have allowed retaliatory taxation on incomes such as interest and dividends earned through their U.S. asset holdings by residents of the countries that imposes digital service tax on U.S. companies. And these countries and territories includes Canada, European Union, India, and UK. I have previously criticized this tax because it contradicts the MAGA, so-called Make America Great Again vision, because the MAGA encouraged foreign investments in U.S., for example, building factories, boosting capital expenditures in America and creating local jobs. However, taxing foreign investors on U.S. assets does the opposite by discouraging investment into U.S. because you never want to punish someone who invests money into your country. So it seems Trump's administration is recognizing this because on June 26, U.S. Treasury Secretary Scott Bessent announced the removal of Section 899 from the Big Beautiful Bill, and its removal is reportedly linked to an agreement among G7 leaders to exempt U.S. companies from the 15% global minimum tax. Although it's unrelated to digital service tax, Section 899 is removed. So this means foreign investor no longer needs to worry about the extra taxes on incomes from their U.S. holdings. So there's one less concern to worry about. And U.S. assets remain just as attractive as ever, especially for the income investors seeking dividend and interest incomes from U.S. assets. In June 2024, Canada passed a bill to officially enact a 3% digital service tax on both domestic and foreign firms with revenue above certain threshold. So this is pretty much targeting the large cap technology companies such as the Silicon Valley ones, right? Like the FANG, the Google, Amazon, all those ones. So the tax is also retroactive to the year 2022, was the first payment due on June 30th, 2025. This move angered Donald Trump, who announced an immediate halt to all trade discussions with Canada, and he also threatened to impose new tariffs on Canada, saying Canada would be notified about the new tariff within 7 days. Treasury Secretary Scott Bessent also stated in an interview that the administration plans to launch Section 301 investigation into Canada, and this tool has previously been used against countries such as China to impose new tariffs. On June 29th, Canada's financial minister announced that Canada has rescinded its digital service tax on U.S. tech firms to advance trade talks with U.S. aiming for a deal by July 21st. This reflects Canada's limited leverage in U.S.-Canada trade negotiations, with a population 10 times smaller and an economy 14 times smaller than the U.S. Canada recognizes it cannot effectively retaliate, and Mark Carney government understand this dynamic. So when Trump pushes back, Canada acts quickly to avoid escalation. So if a trade deal is reached in July between U.S. and Canada, it likely will favor the U.S. and hurt Canada overall economically. So a similar outcome can be expected for other countries who are currently negotiating with U.S. because U.S. have the most leverage, and the goal of even having all these negotiations using tariff tactics to bring everybody to the table to negotiate is to benefit U.S. Donald Trump is not negotiating trade deals to benefit other countries. While many people are talking about de-dollarization and U.S. capital outflow, these are largely superficial reaction to the tariff threats. If high tariffs stay in place for a long time, a permanent capital outflow would make sense based on the balance of payment theories. However, in reality, tariffs don't stay that long, right? Tariffs are just leverage tools that used by Trump to pressure countries to sign or bring them to the negotiation table to sign trade deals that ultimately benefits U.S. Once the trade deals are in place, the tariffs are lifted. The majority of the tariffs are lifted, so capital flows back into U.S. as a result. This chart shows you the U.S. dollar index on a monthly time frame. So each candlestick represents a month. Okay, it's a monthly chart. So since the start of 2025, we see 4 red candles, right? There's a sharp decline, of course, but it's very important to note the current level is at the same level as pre-pandemic. So pretty much the dollar returned to a pre-pandemic range. Everything looks more like a reversion to the mean rather than a structural breakdown of the dollar. And this chart shows you Euro stocks 50 index, pretty much capture the 50 blue chip stocks in the Eurozone, divide by S&P 500 price, right? So at the start of 2025, right here, we're seeing an uptrend in the ratio, meaning that the money is flowing out of US into Eurozone. And since the beginning of April, the thing downtrends, meaning that the money flows back from Eurozone back to US. This return of capital can also be observed by looking at S&P 500 price, right? We have seen a sharp reversal of the price. If you look at the black line representing this year, okay, so S&P 500 dropped 18.9% from February 19th, which is a record all-time high back then. It dropped 18.9% and bottomed on April 8th. And within 89 days, it starts to make all-time high again, which is the last trading day on June 27th. Only 89 days it took. And this marks the fastest recovery from a 15% plus drop in S&P 500 history. This is beating the record in 1998, which took 90 days. Okay, and in comparison, 2020 is here, this color here, right? For the year 2020, it took 125 days to recover from the COVID bottom to an all-time high. And we used to call that a V-shaped recovery because Federal Reserve was pumping so much liquid that has never been seen before. Okay, but these two, so 2025 and 2020 is not 100% comparable because in 2020 it dropped to minus 35%. It's a lot deeper in terms of the damage. So as a conclusion of this video, I think there's 2 key factors to remember. One is the removal of Section 899. So there's no more tax on U.S. asset or U.S. fixed income investors, right? People who rely on dividends and fixed income, they're no longer subject to new tax. And the second point is that as the deals, more and more deals come in, U.S., we should expect that U.S. would be the net beneficiary of all the trade deals. And as the deals come in, the tariffs are dropped, the U.S. business and corporate America will likely benefit. Despite ongoing talks about de-dollarization and paradigm shift, such changes will remain still far, far away from where we are today. Okay, so as a retail investor, I still feel like it's smart to be bullish on U.S. equity.